Good afternoon. I'm Dr. Fasasi Kazim Adiola. We'll be looking at an important topic this afternoon, and the topic is called subsidiary books. It is important as a beginner to know what books is needed to record what transaction. Each transaction is unique, and each transaction has its own books, different from another books. In our last video, we talked about subsidiary book. And we said subsidiary book are books of original entries where transactions are recorded permanently. They are also known as journal. They are books where transactions are to be recorded first. In that case, what are these subsidiary books? We mentioned it in our last video, but we would like to bring it again. We have the 6-day book, or we call it sales journal. 2, we have the purchases day book, or we call it purchases journal. We have the sales return book, or we call it return inward journal. Also, we have what we call the purchases return book, or we call it return outward journal. Also, we have the cash book. 6, we have what we call petty cash book, and we have the general journal. These are the 7 subsidiary books, and we are going to look at their calculation in details, one after the other. We are going to look at what do we use sales day book to do, purchases day book, return inward, return outward, cash book, petty cash book, and general journal. With this, today's lecture, we are going to cover 1, 2, 3, 4. Why? We know them as special journal. In that case, today we'll be looking at the sales day book, the purchases day book, the sales return book, the purchases return book. And in our next video, we'll be looking at cash book. Let's start with today's topic. Firstly, what is purchases day book? Purchases day book is a subsidiary book. It's a subsidiary book used to record goods, but on credit, or we said credit purchases. When goods are bought on credit from supplier, the appropriate book to record this transaction is purchases day book, or we call it purchases journal. And the format of purchases day book, the format of purchases day book, we have the date of the transactions, we have the supplier's name, the source document, we call it invoice number on the source document, and we have a total. This is the format of purchases day book. It is used to record goods bought on credit, and the format is date, supplier's name, invoice number of the source document, and total. Also, let's look at purchases sales day book. Let's look at sales day book. Sales day book Sales day book is a subsidiary book used to record goods sold on credit, or we said credit sales. When goods are sold on credit to customers, the appropriate subsidiary book to record such transactions is sales day book. And let's look at the format of sales day book. The format of sales day book, we have date, customer's name, invoice number of the source document, and we also have a total. This is the format of a sales day book. It has date, it has customer's name that you sold to on credit, it has invoice number, and it has a total. Let's look at the third special journal. We have the purchases return book, or we can call it return outward book. And what is purchases return book? Purchases return book is a subsidiary book. It's a subsidiary book used to record goods return to suppliers. Suppliers as a result of damaged goods. Now, when goods are returned to supplier, when goods are returned to supplier, when goods are returned to supplier, a debit note is received as evidence that goods is returned. What does this mean? When you return goods to supplier, you don't only return goods by mouth, because when you return goods to supplier and you return by mouth, in the future, the supplier can deny that no goods has been returned. Due to this, when you buy goods on credit and some of those goods has been damaged, and you are likely to return the goods, or you have returned the goods, remember to receive a debit note as a source document from the supplier to show evidence that such goods has been what? Returned. So that, for example, if you have purchased 1,000 naira goods, and out of 1,000 naira goods, 200 naira goods has been damaged. What it means is this: when you bought the 1,000 naira goods, you will receive an invoice from the supplier for 1,000 naira, and that will be recorded in the purchases day book. Now that you have returned 200 naira goods, the same supplier must give you a debit note as an evidence that goods has been what? Returned. So that on the day of payment, you will go to the cashier with both the invoice and the debit note. The duty of the cashier is to deduct the 200 naira debit note that you have returned from the invoice of 1,000 naira, so that you make a payment of 800 naira. What's the format? Let's look at the format of return outward. Return outward journal. It has date. It has a supplier's name. The source document is known as a debit note number, and it also has what? Total. This is the format used to record return outward book, or we call it return outward journal, or we call it purchase return book. Let's look at the last special journal before we go into illustration. The last special journal we are going to be looking at is known as a sales return book, or we call it return inward journal. What is return inward journal? Return inward journal is a subsidiary book used to record goods returned by customer. When customer return goods, a credit note is given to the customer as evidence of goods what? Return. Just like purchase return journal. When a customer return goods back to your business, you don't just collect it by mouth. You also collect the goods and give the customer a credit note as an evidence that those goods has been returned back to your business. In that case, debit note is received from a supplier, while credit note is given to customer. The format of return inward journal is date, customer's name, credit note number, and total. This is return inward journal format. Now, having looked at this first special what? Journal, what we are going to look at again before we go into the calculation aspects is trade discount. What is trade discount? Trade discount is a deduction from the cost of goods. Trade discount is given to encourage customer to buy in large quantity. We give trade discount to customer to encourage those customers to buy in large quantity. There's an adage that said, buy two, get one free. That is trade discount. When you know that if you buy two, you'll be giving one free, you may decide to buy four so that you can get two free. The trade discount is a deduction from the cost of the goods, and it is given to customer to encourage them to buy in large quantity. We may be applying this trade discount when goods are bought on credit or goods are sold on credit. Now let's look at illustration on subsidiary book. Let's look at illustration on subsidiary book. We'll divide the board into two in order to minimize the board. While looking at this illustration, the following transaction was extracted from the book of Kunta Venture as at February 2020. February 2nd, bought goods on credit from Jamil Store, Aminu Store, less 10% trade discount. February 10, sold goods on credit from Emeka to Emeka and Son and Simba Venture. February 21, goods returned to Jamil Store, less 10% trade discount. And February 28, goods returned from Simba Venture. Required, record the transaction above in appropriate subsidiary books. B, post to the ledger. Now we're going to be looking at solution to this illustration. We're looking at Kunta Venture. Now, in Kunta Venture, on February 2nd, bought goods on credit. So far, the question says bought goods and is on credit. The appropriate subsidiary book is purchases day book, and it has date, it has a supplier's name, it has invoice number, and at the same time it has a total. Who did they buy from? On February 2nd, goods were bought from Jamil Store, less 10% discount. Meaning, we'll come here, for Jamil Store, there's 10% discount. How do we do that? The cost is 20,000. There's a trade discount. Now, the trade discount is how many percent? 10 over 100 times 20,000. That will give us 1,000. Now, it's a deduction. We don't record trade discount. It's just a deduction. We minus the 1,000, meaning we have 19,000. Under the total column, we put Naira and put 19,000. That's how we arrive at the 19,000 for Jamil stock. At the same time, on the same date, they also buy from Amino store. Under Amino store, you're not to show the working. Your own is just to give the final figure. But this is how we arrive at the final figure. The cost of Amino is 10,000 Naira. The trade discount is 10 over 100. That's 10% of 10,000. That will give us 1,000. What do? The bracket shows you are lessing. In accounting, when you bracket, it shows you are minusing. Minus this, you have what? 9,000. We come here, Amino store is 9,000. The reason why the invoice place is empty is that the question does not have invoice number. If it's in practice, you put the number on the invoice on this space. You put the invoice number. We're done with that. The next question said sold goods on credit. Sold goods on credit to Emeka and Son and also to Simba. Sold goods on credit. The appropriate subsidiary book to sold goods on credit is sales day book. You draw another table for sales day book. We have date. Now this is sales. It is customer name. We have a invoice number and we have a total. Under the sales day book, on February 10, who did they sold to? They sold to Emeka and Son. Is there discount? No discount. That means just come here and record 30,000. They also sold to Simba Venture. How much did they sell to Simba Venture? 40,000 Naira. Now, on February 21, goods were returned to one of the supplier. So far, they said goods returned to, you are going to open, who is returning? Kunta Venture is returning out. That's why we have return outward journal. And it has what? Date. It has who did they supply to? Supplier's name. Because it's written outward, the source document is known as debit notes, and we also have a total. Now, on February 21, goods were returned to what? Jamil store. Remember, there's a 10% discount. 10% of 5,000 is 500. That is, the cost is 5,000 and there's a discount of 10%. 10% of 5,000 will give us 500. When we minus it, we are going to arrive at 4,005. That's how we get 4,500. This is just a working and you are not to show it. You are only to show the total amount. Now, this has been recorded. We also have return goods from Simba. That's return inward. Simba return goods back to Kunta. That's return inward journal. And that's we have a date. We have Who returned the goods back? That's customer's name. The evidence of return, we call it credit note. And the amount of goods returned is called total. Now, what do we do? On February 28th, who returned the goods back? Simba Venture. And how much goods was returned? 10,000. We have come to end of recording the subsidiary book. You don't leave the subsidiary book open. You have to balance the subsidiary book. How do we balance? Purchases day book. If they are 10 here, you add all the total together, and this is 28,000. This means this total goods bought from the supplier in the month of February, and that is February 28th. That's the end. Now we'll now come here and say transfer to debit side of purchases account, meaning from the subsidiary book to ledger, it will be transferred to debit side. For the sales day book, we'll add it together. This is 70,000, meaning in the month of February, the total goods sold on credit is 70,000 from all their customers. We'll also come here, February 28th, meaning they are selling the goods out. We'll now say transfer to credit side of sales account, meaning when it gets to ledger, it will be transferred to debit side. Now also, we have only one supplier that goods were returned to. Just come here and put 4,005, and that is on February 28th. We will say transfer to the goods is going out, credit side of return outward account. We are done with this. We also come here. We have 10,000 on February 28th. They are returning the goods inward. We'll say transfer to return inward, transfer to debit side of return inward account. Now this is the subsidiary book. This is solution A. They now said on the accounting process, from the subsidiary book, transactions are posted to ledger. What have we done today? Bought goods on credit has been recorded in the purchases day book. Sold goods on credit has been recorded in sales day book. Return goods to the supplier have been recorded in return outward journal. Return goods from the customer have been recorded in return inward journal. Now, how do we post the whole of this subsidiary book, this special journal? How do we post it to ledger? Want to post it to ledger, one after the other, but how do we post it to ledger? Now look at this. Let's post purchases day book first. I've told you that ledger indicates double entry, and we have done double entry in our previous video. How do we post to ledger? We have talked about ledger in details, but here now we want to follow the normal accounting process, which is first record it in the subsidiary book, and from the subsidiary book, take it to what? To ledger. How do we do that? Let's start with the purchases day book. Purchases day book is a subsidiary book. Purchases account is a ledger. Now this is where we will see who is the receiver and who is the giver. And let's start with purchases account. The question is this: purchases. Conta venture is receiving goods, and we said debit the receiver and credit the giver. Now, this stands for goods they have received, bought goods. Now, the ledger will show us now that they are receiving. How many goods did they receive in total? They received 28,000 goods. We'll come here at the end of the month, February 28th. We'll refer all the suppliers as sundries. These sundries stand for Jamu. These sundries stand for Aminu. How much goods do we buy from them? We bought a total goods of 28,000. For every debit entry, there must be a corresponding credit entry. Who are the people that we are going to credit? Firstly, we'll credit Jamu store account. This is the supplier. How much goods do we buy from Jamu? 19,000. Jamu is the one supplying. And we have said when you are giving out, I can't say you should credit. Who is giving out the goods? Jamu. The goods is given out has been debited. And who is giving it out? Supplier Jamu. And that is February 21. Our particular, February 2nd, our particular will be purchases. How much? 19,000. Don't forget to put Naira sign. Who is the second supplier? The second supplier is Aminu. Is it Aminu? Aminu store account. Credit Aminu. February. That's purchases. How much goods do we buy from Aminu? We bought 9,000. For every debit entry, there is a corresponding credit entry. What it means is this: we have transferred purchases day book to purchases ledger. And why purchases day book is transferred to debit side of purchases account. Once you transfer purchases day book to debit side of purchases account, if there are 50 names inside it, it means you are going to open 50 ledgers and do corresponding entry to credit what side. What it means is this: purchases day book has been transferred to what? Purchases ledger. And in that case, it has been cleaned. You see that it's no more there? I've transferred it from the subsidiary book to ledger. Next is return outward. Reason is this: from return outward, you transfer it to return outward account. From double entry perspective, return outward means Punta Venture is giving the goods out. That's why they say we should transfer it to credit side. Now, that is February 28th. We are going to refer all the name inside as sundries. How much goods? 4,500. Remember to put Naira sign. For every credit entry, there must be a corresponding entry to Jamu. The Jamu is already there. You don't need to open another Jamu. And who did they return the goods to? Jamu. On February what? 21. You just put return outward 4,500. Return outward. What it means is this: on the 2nd, they bought goods of 19,000 from Jamu. Credit is giving the goods out, and we have returned 4,500 back to Jamu. That is, Jamu is receiving the part of the goods back, and that is double entry, which is very key in introduction to accounting, and that is in our previous video. Please make sure that you study the double entry very well in the previous video before you come to subsidiary book. It will help a lot. In that case, I've posted return outward book to return outward account. You now see the next two that remain. The sales day book. Goods sold on what? Credit. What do we say to? We sold goods to Emeka and Son and what? Simba. Now we are selling goods out. Sold goods out. It means transfer to credit side. When you are giving out, you credit. This goods is sold out by what? Counter. And what's the total goods that was sold out? 70,000. You open what we call from sales day book, you open sales account. Now this will show us what counter is receiving and what counter is giving out. This goods sold out is going out. You say on February what? 28th. This is sundries. Sundry represent Emeka and Simba. How much goods? 70,000. For every credit entry, there must be a corresponding debit entry. Who is the first person? Emeka. Emeka and what? Son's account. These are the customer you sold goods to on credit. For every credit entry, there must be a corresponding debit entry. On February 10, how much goods do you sold to Emeka? Your particular will be sales to show that goods were sold to Emeka. How much? 30,000 naira. We also have what? Simba. Simba venture account. Now let's look at it. How much goods to Simba? February 10, 40,000 goods were sold to what? Your particular will be says 40,000 naira. Now what this means is that we have posted from the sales day book to sales account, showing that goods is going out. And for every credit entry, we have debit all the customer that this goods has been sold to. We have debit Emeka 30,000 and debit Simba. What it means is that I've transferred the subsidiary book of sales day book from sales day book. It has been transferred to what? Sales account. Now, what's the last one? Return inward. Return inward means the customer has returned back, and we are going to take it to return inward account. Return inward account, and it must follow double entry. When you are taking the subsidiary book to ledger, it must follow double entry. Where are you transferring it to? Debit side, inward. The goods is coming back. On February 28th, you refer it as what? Sundries. What does this sundries represent? It represents Simba. And how much total? The total of goods returned back is 10,000. For every debit entry, there must be a corresponding entry to Simba there. And that is February 28th. We have a return inward. How much? 10,000. If you now look at it now, all the subsidiary book has been transferred to ledger. The total return inward has been debited to return inward account, while the corresponding entry, which is the Simba, has been taken to credit side. Now, from subsidiary book, it has been posted to ledger. Please mind you, don't clean your subsidiary book. It's because we want to manage the board. What we do is that we transfer the sales day book to sales account, and the sundries there represent Emeka and Simba. We transfer the return inward book to debit side of return inward account, and the corresponding is Simba. We transfer the purchases day book to debit side of purchases account, and for every debit entry, the sundries there represent Jami and what? Aminu, corresponding entry credit. We transfer return outward to credit side because goods is going out. And what is the goods going out back to? Is going out back to Jami. This is one problem solved. Another problem solved is to close all the what? All the accounts. I've taught you how to close accounts in our previous video. This is balance carry down 28,000. Close the account and come here and put balance what? Draw down 28,000. Let's come here. Jami 19,000 minus 4,500. This is the higher side, this is the lower side. The lower side always have the balance carry down on the 28th of the month. We will now say 19,000 minus 4, 5. That will give us 13,500, if I'm correct. If I'm correct, we'll close the account. This 19,000, 19,000. Let's see. This 13,500 plus 5, that's 14. This is 14,500, because 14,500 plus 500 is 15,000 plus 4,000, that's 19. This is correct. Now, this is balance brought down, that's 14,500. What this means is this: they bought goods of 19,000 from Jami, they return goods of 4,000, meaning Kunta Venture is owing Jami 14,500 in the month of February. No amount has been paid out of the money. Now, for Aminu, balance carried down 9,000. Two line means the account has been closed, and we have balance brought down 9,000. For return outward, February 28th, balance carried down 4,500, and we come here, balance brought down 4,500. For Simba, let's close it from sales day book. We have February 28th. We have balance carried down 70,000, account close. We have a balance brought down 70,000. For Emeka, we have February 28th, balance carried down 30,000, close the account for the month of February, and we have a balance brought down 30,000. For return inward, February 28th, we have balance carried down 10,000. Let's close the account, and I will come here, balance brought down 10,000. For Simba, they sold goods of 40,000 to Simba, and Simba have returned 10,000 out of it. It means if Kunta Venture sold goods of 40,000 to Simba, and Simba have returned 10,000, we are going to say 40,000 minus 10,000, and that will be our balance carried down. 40 minus 10,000, we have 30,000. What it means is this: Simba Venture is owing Kunta a sum of 30,000, and the account has been closed. And this is a balance BD 30,000. For some